In this session, we will discuss our next behavioral bias, anchoring. Investors tend to use the previous major peaks or bottoms or the 52-week high, that is the highest price observed during the last 1 year period, as mental anchors. That means they will overemphasize the importance of this level. They will perceive this level as a fair value, as the normal trading price of the stock. And when they receive information that the stock price should move far beyond this level, they would underweight such information. So using a price level as a mental anchor causes you to overestimate the importance of that level and to underestimate the importance of the new information that requires the level of the stock price to change. Look at the graph on the screen. You see two major peaks. This is the graph of the S&P 500. These two major peaks probably became a mental anchor in most investors' minds. Those investors who sold their stocks near those peaks were rewarded by being able to buy them at much lower prices later on. Those who failed to sell at those levels will regret their decision. So therefore, when the market approaches to this level for the third time, many investors will be inclined to sell because they use this previous peak as a mental anchor. But as you see, after the impact of the 2008 crisis was over, a much higher level for the S&P 500 index was warranted, and the market moved way above this level. During this run-up, the anchoring bias has probably slowed down the uptrend. Normally, the market could have adjusted to its new level, which is much higher, at a faster pace. But as you see in the picture, a gradual uptrend has emerged. This is the type of uptrend that technical analysis signals would capture. This is the type of uptrend that momentum strategies would benefit from. Most probably, this uptrend, which you see by the blue arrow, was reinforced by the anchoring bias, which caused some investors to sell against it. What is the implication of the anchoring bias for the individual investor? Individual investors are vulnerable to this bias because as a major level that helps our brain process information more efficiently. Just I remember that major level, and because it has priority in my mental processes, I overemphasize its importance. But sometimes it causes suboptimal behavior. It negatively affects our performance. How should we avoid being negatively affected by the anchoring bias? When the market is approaching to a previous peak or the 52-week high, we should double-check our analysis. Do we now have new information that would require significantly higher levels, that would require the market to overcome this level? Especially when the price rises above the previous peak, at the same time you would have a technical analysis buy signal, you should do this analysis more carefully so that you ensure that you're not underreacting to this new information because of your anchoring bias. So if you can manage to be careful about this, it may help you being on the wrong side of the market during major trends. We have an interesting study that may exemplify the impact of the anchoring bias. This is the 52-week high momentum strategy elaborated on in this research paper by George and Huang in 2004. In this study, they construct a strategy of buying stocks which are closer to their 52-week high. If you buy and hold these stocks for the next 6 to 12 months, you will beat the market by 1% per month, or about 12% per year. This is a statistically significant overperformance, and it implies that the market is inefficient. These researchers argue that this anomaly probably results from the anchoring bias, that is, investors underestimating the importance of new information by focusing too much on their anchors, that is, the 52-week high price. To summarize, the impact of the anchoring bias on the whole market could be underreaction to slow down the adjustment to the new information and therefore causing profitability to the momentum strategies and market trends.